Second reason, willingness to borrow drops. On the surface, rate cuts should make loans cheaper and stimulate home buying, car purchases, and business investment. But think about it. If you knew rates would be even lower in 3 months, would you rush to borrow now? No. Many young people planning to buy homes hear more cuts coming and decide to wait. Businesses are the same. If they're already pessimistic about the future and see rates falling further, they won't rush to expand. So instead of boosting cash flow, the Fed's rate cuts make everyone delay their plans, freezing the credit market. Third reason, uncertainty sticks around. Rate cuts can't fix the uncertainty from tariffs, immigration, or policy flip-flops. Imagine a small business owner planning to expand their factory, but if they hear tariffs might increase next month, eating into profits, they'll shelve the plan. Hiring is the same story. If immigration policies tighten and workers are hard to find, even with cheaper loans, they won't dare expand blindly. JP Morgan calls this the uncertainty tax. Americans are paying what's worse. Rate cuts send a signal that even the Fed thinks a recession is coming. When businesses and consumers see that, they become even more cautious. So when you put these three together, it's basically demand shrinks, credit freezes, confidence vanishes. If these three key pillars collapse at the same time, how can rate cuts possibly save the US economy? This is a lot like the Nixon moment in the 1970s back then to secure re-election. Nixon kept pressuring the Fed chair to cut rates in the short term. It made the stock market and economy look great, but soon the cost hit, inflation went out of control, and stagflation plagued the US for a whole decade. Today, Trump wants to copy that election politics plus easy money script, but the market has been through too many rounds of easing and stimulus. It's built up immunity. This time, the Fed's medicine might not only fail faster, but could backfire on the whole market. I think JP Morgan's view is pessimistic. Wait till you hear Goldman's logic. They say the US economy is on the brink of stagnation, and even if the Fed cuts rates several times, we won't see real recovery until 2026. Anhats, yes, Goldman's chief economist said, I think we're close to stalling. Pay attention, he didn't say might stall in the future, he used the present tense, we're already close. That's a heavyweight statement because Goldman isn't some random retail investor shouting doom online. They're a top-tier global investment bank with massive models, data, and boots-on-the-ground research. And they've got tens of millions of clients counting on them. So what's their evidence? First, the job market. August non-farm payrolls grew by just 22,000 against expectations of 75,000, less than a third. Even worse, June and July numbers were revised, down by 21,000 combined. Don't underestimate that 21,000. When you add it to the revised 910,000, it paints a collapse-style truth. The U.S. job market isn't as healthy as the White House claims.